Welcome everyone. Today we are going to be studying professional responsibility and liability when it comes to auditing. Subscribe to our YouTube channel if you want to get all our lectures. You just need to hit the subscribe button so that anytime I post a video, you'll be the first to get it. Now we have social media handles, Facebook and Instagram. So you can find us on Facebook at Pinnacle Professional College and Instagram as well. You can follow us, like our page, comment, and just leave a good review for us and tell us, that you appreciate the work we are doing. Now let's move on to today's objectives. Today's objectives, we'll be talking about the auditor's liabilities and the expectation gap. And then we'll be moving on to talk about professional skepticism. And then we'll talk about fraud versus error. What is the difference between these two? And then we'll, dive a little bit into permanent indemnity insurance if we have some time. So let's start. Let's begin. So this session deals with a number of aspects of law and regulation, under which auditors may have either penalties imposed on them for a criminal offense or legal claims raised against them for some form of negligence. These days, the potential liability of auditors has become a very, very important topic because of, the many corporate scandals that have been following the audit industry. And also due to the complexity of businesses. Today, businesses are more complex than businesses 100 years ago. And things are changing in the business environment. Things are changing in the external environment, the legal environment. And that is triggering the discussion around the potential liability of auditors. One explanation that has been put forward to explain the high number of legal actions against auditors is what we call the expectations gap. These days, there are a number of legal actions or lawsuits against auditors. There are a number of legal actions or lawsuits against auditors. And so one of the reasons is due to the expectations gap. So what is the expectations gap? You can also call it the audit expectations gap. So what's it all about? The expectation gap is simply the difference between what the users of the financial statements think the auditor should do versus what the auditors are actually required by the law and by the profession to do. Very, very important. Let me repeat that again. The expectation gap is simply the difference between what the users of the financial statements think the auditor should do versus what the auditors are actually required by law to do. So there are three main elements when it comes to the expectations gap. There's the standards gap. This occurs because there's basically a perception that auditing standards are more prescriptive than they actually are. So when we say they are prescriptive, they are, giving you exact recommendations and suggestions on what to do, So what people don't know is that the auditing standards are more of a guidance rather than prescriptive rules that it may want to offer. So there's a perception out there that auditing standards are more prescriptive than they actually are. Anyone who is in the profession will understand that auditing standards offer guidance. These are principles. It adopts the principle-based approach versus the rule-based approach. The second misconception out there is the performance gap. This occurs because there's a perception that audit work has fallen below the required standards. Out there, people think that because of the corporate scandals that has been falling, the audit industry and all that, the audit work has fallen below the required standards. Then you have the liability gap. This arises from a lack of understanding about the auditor's liability and who the auditor is actually liable to. So you need to understand, in the case of any issue, you need to understand who the auditor is liable to. And there's sometimes a misunderstanding out there. So what are some of the consequences of the expectation gap? We said that the expectation gap is simply a difference between what users of the financial statement think auditors should do versus what auditors are actually required to do. What auditors are actually required to do. So the consequences of the expectation gap include high rates of litigation. Because of the expectation gap, there's high rates of litigation. Legal actions are brought against auditors very, very often. Because of the expectation gap as well, there's an increase in the mutual distrust between the auditing profession and users of the audit reports. So there's a mistrust between auditors and the users of the audit reports. So these are some of the consequences of the expectation gap. These are some of the consequences. So how do we close this gap? We need to understand how we can close this gap. There are a number of strategies that exist that could help in closing the expectations gap. The profession should attempt to generally improve the level of understanding about the audit process. Generally out there, people have this big misconception about the audit profession. So what the profession should do is to educate people, give them knowledge and understanding about the process. Also, if there are controls around or over the auditing profession, it enhances public confidence. If there are visible controls over the audit profession, enhances public confidence. Another way you can close the expectation gap is to ensure that there's significant guidance that is centered around increasing quality. Increasing the quality of the audit reports, increasing the quality of the audit report. And also, one thing you shouldn't forget is about communication. Once the communication lines are open between internal and external auditors, the audit committee, etc., that collaboration and communication helps to reduce the expectation gap. Very, very important. Also, enhance communication between the parties, that is the auditor and the clients, around the confirmation of roles and responsibilities. Because the whole premise of the expectation gap is that there's confusion as to the responsibilities of the auditor. So when we are able to firm up that properly, that everyone knows their responsibilities, everyone knows their roles, the expectation gap is closed in that regard. So these are some of the ways that we could close the expectation gap. Now let's move on to professional skepticism. The IASB is simply the International Audit and Assurance Standards Board. International Audit and Assurance Standards Board. So it has some question and answers about professional skepticism. So first off, what is professional skepticism? In simple terms, it's simply the auditor having an inquisitive mind. The ISAs define professional skepticism as an attitude that includes a questioning mind, being alert to conditions that indicate fraud, and also having a critical evaluation of audit evidence. Critical evaluation of audit evidence. So it's basically having curiosity, an inquisitive mind, being able to ask questions, being alert, being aware, critically evaluating audit data. Very, very key. So why is professional skepticism important in audit of the financial statements? It's important because it plays a fundamentally important role when it comes to the auditor skill sets, right? It's important specifically due to the fact that it affects the auditor's professional judgment, right? The better the auditor's questions, the better the auditor's skepticism, the better their professional judgment. So you would want auditors to be professionally skeptical. And so professional skepticism is closely related with professional judgment. The better the questions, the better the answers. Then let's talk about what can be done by audit firms and auditors to enhance the awareness of the importance of professional skepticism and its application. What can be done? we said here that professional skepticism within the engagement team is also influenced by the actions of the firm's leadership and the engagement partner. So to create awareness about the whole issue of skepticism, we need to, the leadership has to be involved, because the tone at the top is very, very important. If the engagement partners, the partners are very, very much interested in building a culture of professional skepticism, they must lead by example. They must lead by example and set the tone in the organization. At what stage in the audit process is professional skepticism necessary? Professional skepticism is necessary throughout the audit, from the time the engagement is accepted to the time the opinion is given. The auditor must, exhibit professional skepticism. How does, the next question again is getting interesting. How does professional skepticism relate to the auditor's responsibilities with respect to fraud? How does professional skepticism relate to the auditor's responsibilities with respect to fraud? Like we said, right? Professional skepticism is always about having an inquisitive mind, So to uncover fraud or to discover fraud, you need to have that skill set as an auditor to be able to ask the right questions, to expose anything that might be hidden or anything that might be concealed. So professional skepticism relates to the auditor's responsibilities in that regard. So that's very, very important. That's very, very important. In addition to fraud, are there other aspects of an audit where professional skepticism may be particularly important? Professional skepticism is necessary and important throughout the entire audit process, but it becomes particularly important in addressing areas that are very complex, that are very judgmental, and that are very material. So areas like, just think about areas where it has a lot of judgmental, a judgmental side to it, like accounting estimates, like related party transactions. Professional skepticism is particularly important in these areas. But professional skepticism on a whole is necessary throughout the entire audit. Now let's talk about how can the application of professional skepticism be evidenced? How can it be evidenced? It can be evidenced through various discussions held by the auditor, held by the auditor during the course of the audit. So that's how professional skepticism is exhibited. For example, the auditor's communication with those charged with governance, right? If the auditor is having conversations with those charged with governance about the audits, trying to ask the necessary questions, that is how its professional skepticism is evidenced. Do regulators and oversight bodies of audit firms and those charged with governance have a role to play in supporting skeptical behavior among auditors? Do regulators have a role to play? The international standards on audits do not set forth any requirements for regulators and oversight bodies of the audit firms. However, because of the critical role of the stakeholders, right, of those stakeholders, and their influence in terms of achieving audit quality, they have their position, they have the authority to challenge auditors. Even though the international standards on auditing have not given any explicit requirements for regulators and oversight bodies, these oversight bodies, because of their influence and because of their strategic importance when it comes to achieving audit quality, they are in a position to further challenge auditors. They are in that position to further challenge auditors. Very, very key. Now let's talk about fraud versus error. Fraud versus error. Two important concepts. The difference between the two is in the intention. Fraud is intentional. Error is not intentional. Fraud is intentional acts. So examples of fraud would be falsification of records, misappropriation of assets, deliberately or intentionally applying accounting policies in an incorrect way, All those are examples of fraud. Then you have error. Error may be defined as the unintentional misapplication of accounting policies. Unintentional misapplication of accounting policies. And you have oversights, clerical mistakes that are intentional. And you have unintentional interpretation of facts. Misinterpretation of facts. The difference here between fraud and error is in the intention. Fraud is intentional, error is unintentional. Now let's talk about responsibilities of management and auditors when it comes to fraud and error. Management is responsible for preparing the financial statement. We've said this in our previous lectures, and management is also responsible for setting up appropriate controls. The control systems are in the hands of management. They are responsible for setting up that, So these two responsibilities are in the hands of management. And so the management, therefore, is responsible for the prevention and detection of fraud and error. They are responsible for that. They are responsible for the prevention and detection of error. Now let's talk about the responsibilities of the auditor. The auditor is also responsible for, providing an opinion on the financial statements as to whether it presents a true and fair view of the financial position and the financial performance of the client. The auditor's responsibility, again, like we've said, is to obtain a reasonable assurance, not an absolute assurance. It's not 100% assurance. It's reasonable. It's a reasonable assurance, a high level of assurance that the financial statements are free from material misstatements. One thing we need to note here is that it is not the primary responsibility of the auditor to prevent or detect fraud. It is the duty of management. The primary responsibility of the auditor is to give an opinion. It's not to detect fraud. Although the audit may act as a deterrent to fraud, auditors may also discover fraud during their audit work, but they are by no means certain to do so whenever error or fraud has occurred. It is not their primary responsibility. Basically, that's what you're saying here. It is not the primary responsibility of the auditor to discover, to detect, or prevent fraud. It's not their primary responsibility. That primary responsibility lies with management. Then you have fraud risk factors. Fraud risk factors are defined as events or conditions that indicate an incentive or pressure to commit fraud. These are incentives that generate in people the willingness to commit fraud. So there are three of them, and that's what we refer to as the fraud triangle. There are three of them, which is incentive, rationalization, and opportunity. I call it the ROI of fraud. ROI of fraud. You already know about ROI, right? Which is return on investment. In this case, it's the ROI of fraud, which is rationalization, opportunity, and incentive. So first off, let's talk about incentive. Incentive. So let's explain incentive as a fraud risk factor. And let's give an example. These are examples we are giving to help you to understand. When there's a high degree of competition in a market accompanied by declining margins, then obviously there will be an incentive to commit fraud. There will be an incentive for management to manipulate the numbers and make the numbers look good when actually their margins are declining. Number two is high vulnerability to rapid changes. This is also an incentive for fraud, right? So, for example, if there's a sweeping technological change that will make a company's product obsolete, then management might find ways to manipulate the financial statements and commit fraudulent activities in order for them to look good. So when there's a high vulnerability to rapid changes, there's an incentive to commit fraud. Also, when there's significant declines in customer demand, that also may be an incentive for committing fraud. And when there's excessive pressure on management to perform, especially when the company is not doing well, there's an incentive to commit fraud. So all these things create that incentive. Basically, when a company is not doing too well, an auditor has to be alert because management might try to manipulate the numbers or commit fraudulent activities. They have rationalization. A typical example is excessive interest by management in maintaining or increasing the entity's stock price or earnings trend. You know why? Because management bonuses will be tied to earnings. So management rationalizes in such a way that they would like to increase the earnings trend just to get more bonuses. Then the next point is that when management is failing to correct significant deficiencies and just saying, oh, it's fine, it's not a problem. When you hear things like that, they are rationalizing. They are rationalizing something that is not good. They are rationalizing a deficiency. And so that's also an example of rationalization. Also, when there are recurring attempts by management to justify inappropriate accounting on the basis of materiality. So when you hear things like, oh, it's not material, let's just forget about it, they are rationalizing it. And it's a risk factor when it comes to fraud. And you have opportunity. What creates an opportunity for fraud? When there's a significant, unusual or high complex transactions. It's an opportunity for fraud. When monitoring of management is also not effective, it also gives an opportunity for fraud. When there's a complexity in the organizational structure, it gives an opportunity for fraud as well. Also, when internal controls are deficient, always remember this, internal controls are deficient, it creates an opportunity for fraud. Very, very important. Very, very important. Very, very important. So let's talk about what will the auditor's procedures be when fraud or error is suspected. When there's a fraud or error is suspected, what will the auditor's procedures be? The auditor should take the following step. The auditor should identify the extent and the possible impact on the financial statement. Should identify the extent and the possible impact on the financial statement, and should document. You should document the facts surrounding the fraud. You should document the facts surrounding the fraud. Now, the auditor has to come and sit down and assess the possible impact on the audit and how it affects the audit risk. Then the auditor must re-strategize the audit plan. Re-strategize the audit plan. The auditor should communicate this on a formal basis to management about this suspected fraud, right? The auditor should communicate, it should be open and go to management and talk about it. But sometimes management, what will you do if management themselves are involved in the fraud? And in that case, the auditor should consider taking legal advice to decide the best course of action. In some very, very extreme cases, the auditor may decide to resign or may think it is appropriate to resign. So basically what we are saying is that the auditor should consider the impact on his audit report to the shareholders. Always consider the impact of fraud on the audit report. On the audit report. So what we are saying here is that if there's an issue of suspected fraud, you need to identify the impact it will have on the financial statements. You need to document the facts surrounding the fraud. You need to come back to your audit plan, right? And see how this fraud affects your audit plan and the risk it poses, and then re-strategize. And you have to communicate this to management. So basically, that's what the auditor has to do when it comes to issues of suspected fraud or error. And so this is where we'll bring this lecture to an end. Thank you for watching this with me, kindly subscribe to the channel and hit the notification bell so that anytime I upload a video, you'll be the very first to get it. Thank you, and it's been a pleasure serving you. Bye-bye.